I'm now joined for some analysis and perspective by Graham Bell. He's a strategist at Old Mutual Equities. Graham, always good to speak to you today, coming through from Cape Town. Let's pick up on the anticipation ahead of the Fed minutes, which will be released today. Your inclination as to how this reading might fare, and more importantly, the impact that it might have on the markets overall.
Hi, Gugu. Yes, Fed minutes out today. The Fed has been giving quite mixed information recently, but this is not because US economic data has been particularly weak almost across the board for several months now. So the Fed is quite unsure about exactly what policy to follow, and they're looking for more clarity. So perhaps you will see in the Fed minutes that they'll be saying that they're not too concerned, and that the data that we've seen over the past few months have really been for specific reasons, but that the underlying economic strength is still there, and they'll be looking forward now to stronger numbers coming through. It is interesting, yesterday the housing starts and completions were very, very strong. So recovery from the winter levels, and in fact made new cyclical highs for those two. And that is an early sign that economic activity is probably picking up steam again. So the Fed is, of course, also having to deal with inflation, and the next inflation reading from the USA this week will probably be another negative, another deflationary number. We're also seeing deflation still from the Eurozone, and in fact the Bank of England, the UK number came out as the lowest for many decades. So inflationary pressures are very muted, and the Fed will have to take this into account. So I don't think that they're going to be in too much of a hurry to hike the rates. But the Fed minutes will probably indicate that the outlook is data dependent, and the data is probably going to look a little bit better. So if you say, well, how does that feed through into equities? Probably over the next few months, as that better US data comes through, markets will once again start to fret that the Fed is in fact going to start hiking rates sometime this year. Probably late this year, but sometime this year. And that will increase market volatility. But I'm not too concerned about that. I think that the underpin for equities is still there. Earnings are likely to pick up in the US and Europe as economic activity resumes. And I think that will provide a very good underpin. And remember always that rates are still extremely low. So even if the Fed was to hike in September or December or whenever it's going to be, they're hiking from a level of 0.25%. And they'll hike by 0.25%, and when they've done that, the rates will still be extremely low. And then they're most likely to sit back and have a look and see what the impact's going to be.
Graham, you touched on the US, obviously, and I want us to focus now on the inflationary factors which you alluded to earlier on. Recently, we've seen data coming out of the UK as well as the Eurozone when it comes to inflationary pressures, and actually moving to the minus or negative inflation, as we've seen in the UK. What does this tell us about those economies, firstly? And secondly, the response that the central banks have been taking by keeping interest rates flat and continuing with the ongoing Eurozone stimulus?
So these much lower inflation rates and even negative inflation have been oil-driven in the short term. So we had a dramatic drop in the oil price, and that's still feeding through into the inflation numbers. But that's just about done now. And in fact, we've also seen it in South Africa that it's already done here, that we had a low of CPI of 3.9%. And as you said just now, CPI just released today for last month has picked up fairly sharply to 4.5%, and is likely to keep on rising. So that becomes an issue for central banks, that there's these great fears about deflation, particularly in Europe, to a lesser extent in the US and the UK. Those fears will start to recede, the worries about deflation, and inflation will come back on the radar screen. But inflation is not going to take off. It's just going to go, become slightly positive rather than slightly negative. So I don't think it's going to spook out central banks at all. And as you mentioned earlier, the Bank of England has basically elected to stand pat and wait. And in addition, in the UK, of course, you've had the Tories win the election, which means that they're likely to still remain fiscally tight. And that will also help the Bank of England to wait before it feels it has to react to any inflationary pressures. So I think it's still an underpin for markets, that central banks are seeing inflation starting to pick up. Rates will probably have to start rising at some point, but it's not immediate and it's not going to be rapid. And that, I think, is still pretty healthy, or pretty good underpin for equities.
It's a great underpin for equities, as you say, but what about the volatility that we've also seen on the bond market fronts, where yields have risen quite excessively?
Yeah, well, yields were very, very low, don't forget. I mean, the German bond yield was down at, what, 0.3% or something, the 10-year bond yield. The US, the 10-year bond yield has fallen well below 2%. And what we have seen over the past few years is, when QE was announced, in the US, for instance, there was several separate occasions when a new tranche of QE was announced. Almost immediately afterwards, bond yields started to rise. So they would fall before the QE and they would rise after. In the case of the European Central Bank's QE, the rates didn't rise. They kind of fell initially. So I think that the increase in bond yields recently has been a consequence of a catch-up, a realization that European economic activity is actually picking up steam, and also the oil price having bottomed out. Brent oil price went, down to $50 or even lower. It's now back above 60. So those two things together cause a pretty sharp reaction from a very low level for bond yields in America and the Eurozone. But I think that that's done now. I think that's a catch-up that's largely done. But looking forward, I do think that volatility will pick up, and that'll probably have an impact on the rand exchange rate, because it's a vulnerable currency. So it's not going to be an easy path for investors in the equity market. There'll be ups and downs, but I think that the direction is still up once you kind of look through the volatility.
Graham, thank you so much for joining us today and giving us your view on the global market space. That was Graham Bowell. He's a strategist at Old Mutual Equities.